All right, you guys. Today I am going to talk to you a little bit about where the rates are and where I think they're going to be going, and kind of just a little bit of the strength of the housing market and so forth. So before I do that, I just want to tell you that this is like my opinion. It is not gospel whatsoever, but it is my opinion. I've got a lot of information. Some of you may have heard of Barry Habib from MBS Highway. That's where I listen to him a lot. And he is like, a lot of these slides have Barry's information in them from MBS Highway. So I just want to make sure that you guys know that and understand that up front. We're going to have some question and answers at the end. So at the end, we'll be able to unmute everybody and be able to have maybe a bit of a discussion at that point in time. So if you can wait for your questions, that would be fantastic. And we can always go back to some of the slides if we need to. Okay. So the housing market is strong. We have limited supply, still have high demand. Interest rates drive the real estate market. And so we've seen that obviously over the last couple of weeks or months, where the interest rates have spiked up and have really just put the real estate market on hold. And it's become a buyer's market, and kind of everything is just kind of sitting there. So the rates really drive the real estate market. Inflation drives interest rates. And so as inflation goes, so do the interest rates. And so over the last couple of months, we've had the high inflation numbers come out. And actually, it's been over the last year, we've seen the inflation just keep on going up. Last November, they talked about it being a transitory inflation and it's going to go away. And while it has not gone away, it has continued to gone up over the last year. And the Fed has really done a lot to impact, to try and impact the inflation and bring down inflation. In fact, they've probably gone a little too hard, too fast, which is what they always do. So that's where we're going to start right now. Let's talk about inflation and just give you a brief definition of inflation. And like I said before, inflation really has driven these rates up over the last 12 months. And so when inflation goes up, so do the mortgage rates. The only exception is during the period of time where we were going through the last couple of years, and the Fed had to jump in and basically buy bonds, mortgage-backed securities, and keep the rates artificially low. So that white line there is really the time when the Fed was buying the bonds, the mortgage-backed securities, and keeping the rates artificially low. But basically, the top blue line here is inflation. And you can see that basically over even the last couple of years, since January of 2018, as the inflation goes up and comes down, the rates just follow that. And so even in this area right here, where, well, we can start back where the QE, they decided not, or to stop buying those mortgage-backed securities and treasuries. And so they said that ahead of time. That's interest rates went up at that point in time. And then they kept on buying for a period of time until mid 2021. And that's when really the interest rates or inflation started to go up, and so did the rates. The rates continued to just drive up. So the blue line here is the inflation numbers going up, and inflation or the interest rates, mortgage rates, just followed the inflation. You can see the inflation came down a little bit. Rates took a little bit of a dive there, and then inflation continued to go up, and we saw interest rates follow. And so that's, we've basically hit mortgage rates at 7%. And this slide is a little bit dated, but basically we've hit the 7% interest rate market because of inflation. So inflation is really just too much money going after too few goods. And as you guys, I mean, this is a real estate, call. A lot of the people on here are real estate agents, but basically it's the same thing. It was just a lot of low interest rate loans that were chasing too little supply of houses, and that has driven the housing prices up higher. That is inflation. It's too much money going after too few goods. It's commercial loans going to big businesses that are borrowing money at really low interest rates and trying to grow their business and get more and become more profitable. But basically it's too much very low loans or low rate loans going out to those commercial companies, Amazon and Walmart and all those guys. And what happens is when inflation goes up, those loans start not being as profitable for them as they had been, and the growth slows as a result of that. The other thing that has been a huge impact on inflation over the last couple of years is the supply chain issues. And yes, this is a real issue that has affected inventories. So as the supply chains got backed up, so did the inventory. And so when you have less inventory out there or less supply out there, then the demand and still have the demand with the more money out there, the prices are just going to go up on those items. And so whether you're at the grocery store or at the gas station or what have you, all of these things are impacted, and the rates or the prices of those things just continue to go up because there's too much money going after too few goods. So, but let me give you an example of even last week when the mortgage market, actually rates came down about 0.5%. And so last week, November 10th, we've been circling this day for a long time because we knew that the inflation numbers, the month over month numbers, which I'll go into in the next slide, were going to show that inflation was coming down. And on November 10th, the inflation numbers were expected to be at 8%, and they were at 7.8%. When that happened, the prices, and this is the prices on the treasuries, went up 200 basis points. And as you can see, 200 basis points is a huge move in the market. That normal, if you look at the past, month of data that I have here, they're really not that big of changes. So 200 basis points was a huge move. And then the yield on the 10-year treasury dropped 30 basis points from 410 down to 380. And this was the impetus last week for mortgage rates to drop by about 0.5% in rate and get into the sixes. So this was all mostly because of the inflation numbers that came out showing that inflation was coming down. And so when the bond market sees it, the stock market sees it, that the inflation is coming down, then those two they rallied, and both of them got better. The stock market rallied huge, and the yield on the 10-year treasury obviously went down by 30 basis points, impacting mortgage rates as well. So when I talk about inflation is measured month over month. It's how much is a basket of goods today versus how much it was a month ago. And we take each month for a 12-month period of time, we add it all up, and basically we get a CPI or inflation number. So as you can see, because of the yield dropping last week, you can see that in October of 2021, that was the first number to go out. So we replaced a 0.6 number in month over month inflation. So a basket of goods increased a year ago from October 2020 by 0.6%. Okay. Well, we included a 0.3% month over month number from October of 2022. So we took out the 0.6% and added in a 0.3%. So right there, if you're replacing a higher number with a lower number and you're averaging it or taking the whole number over 12 months, you're gonna see the inflation numbers come down. Okay, so over the next 12 months, really, as the Fed, we're going to see the impact of the Fed increases of their Fed funds rate going up. We're going to see the effects of the supply chain issues getting resolved. We're going to see less government stimulus and corporate growth. And so with all of those things, you're going to see the inflation numbers come down further and further. And so these numbers that you're seeing in this box here, this green box, those numbers are going to be replaced by not only lowered numbers, but maybe even negative numbers, because we're going to have to bring the inflation down further and further in order for the Fed to stop having those rate increases to slow down the economy. So one big piece of the inflation numbers is shelter inflation. And shelter inflation is basically, when it comes down to it, it's rents, okay? Rents, it's a little bit of a lag. So when you take this shelter information, we see, at least at this point in time, in fact, on the next slide, you'll see it, that the rents are starting to come down now from the last 6 months, last 12 months, really, okay? But we're not seeing those impacts as of yet. Before I go to the next slide, I want to tell you that this shelter inflation is 39% of the CPI or the inflation numbers. So it's a huge, huge number when the inflation is compute when it's added up. The shelter inflation is a big piece of the CPI numbers. And so it's, again, I'll go to the next slide here. So basically, there's not going to be an impact on the shelter inflation, which will bring down the CPI or bring down the inflation numbers until January or more likely February. Because you've seen, and I've talked to a couple of the agents out there, but basically there's been some reductions in rents that I've heard of over the last 30 days. And so this is just a confirmation of that, is that year over year, the inflation numbers or the rents have come down by 5.9%. So from October of 2021 to October of 2022, they've gone down by 5.9%. I'm going to rephrase that. They're only up by 5.9% from last year. Whereas in November, September, October, November, they were up by 18%. So you're seeing this drag on the rents, on the rates of rentals, okay? And so this is kind of a word picture of where we see this. So we basically see the real shelter costs or the rates on the rentals, they're already coming down. So this is like a roller coaster going up to the top. It's click, 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 up to the top. And half of the roller coaster is on the downward side, and the other half is still going up. And so we know that the shelter costs or the rental rates are they're starting to come down here, but the shelter and the CPI is lagging all the way back here. And so we will not see that until we get into January or February of this coming year. But when that does happen, you're going to see the inflation numbers come down quite a bit, because it is 39% of the total CPI numbers. Okay, so I'm going to transition from inflation into a little bit of the recession and employment or unemployment numbers. The first 2 quarters of this year showed a negative GDP, which is gross domestic product. And when you see a negative GDP, that is the growth is negative. We're going backwards. So the U.S. economy was going backwards. The third quarter was at a positive growth. But there's 2 more revisions to that we have not seen and before it's finalized. What I want to talk to you about here is basically that as interest rates go up and the Fed increases the Fed funds rates, you start to see recessions. And what I'm telling you about, these dark lines in the middle are basically recessions over the last 40 years, okay? And so you can see that as the interest rates go up, we go into a recession, but after we're in a recession, the interest rates fall back down every single time. So you go into a recession, they come back down. You go into a recession, rates coming up, they come back down. So every time they come back down. And this is a little bit dated because interest rates are now in this range right here. And if you don't think that we're in a recession right now, we probably will be in the near future. Go a little bit further in deep. If you could mute your phone, that would be fantastic. Mute your computer.
I'm trying.
No problem. So let's see here. So we're going to be in a recession, and then the next slide here is basically how can we be going into a recession when we're at full employment? So we were at 3.5% unemployment as of a couple of weeks ago, and so we have full employment. Everybody was all the companies, there very little unemployment numbers, right? Well, let me just tell you that every time, again, this is another slide that basically shows the recessions. So those blocks, those lines that you see that are going vertical, the shaded lines, those are all recessions. If you look before that, the line that is going up and down here, every time that you are at full employment for that particular time is right when you go into a recession. So right before that, you see that the numbers, the unemployment rate goes up. And we have just seen that. We've crossed that line on the last unemployment report. Basically, it went from 3.5% to 3.7%. Jobless claims are up. So they're continuing to go up, and continuing claims are going higher. That means that people that have already gone into unemployment, there's more people that are filing continuing claims. So they've filed for unemployment, and they continue to file for unemployment, most likely because the companies are not rehiring those people. And so we're starting to see that it's getting harder and harder to get hired again once you've gone into unemployment at this point in time. Okay, and so to back that up, we have Fed Chairman Powell basically saying there's more room to go. There's more rate hikes ahead. We're not going to pause early. We need to make sure that we take care of this inflation. If we go too far on the Fed hikes, we can always lower them back down. Well, that's what he's continuing to say, and that is true. He has to do things to make sure that we take care of this inflation. But as it relates to kind of the business and unemployment, you have all these companies. You have Salesforce, Snap, Meta, Lyft, Amazon. They're all saying they're laying off people or not hiring any more people. Remember how we had a glut or had a shortage of chips for cars and all the things that utilize chips? Those, we have a glut of those, but they're putting a hiring pause on all of those companies because of the glut of inventory that they are having with the chips. So we're starting to see inventories go up, and more and more companies are telling us that basically they're laying off more and more people, and the unemployment rate is going to go up. So as we transition out of the unemployment, I'm going to go to housing. And housing is another kind of huge driver in the economy. And right now we are at a standstill, but that's mostly because of interest rates. If the interest rates were lower, the housing market would be more fluid. And really, a lot of the media drives some of these items. And in the past, I've shown this slide before, but basically, if you would have listened to some people in the economy, or I'm sorry, in the media, you would have lost out on $200 and some odd thousand of appreciation from October of 2015, because they said in 2015, housing today is a bubble larger than 2006. We're in a housing bubble. November of 17, home ownership doesn't build wealth. It's just on and on and on. So if you would have listened to the media, you would have actually lost out on a couple $100,000 of equity in your house. And not only that, low interest rates at the same time. You guys all know this, but real estate creates wealth as well. So even what we think is going to be low single-digit appreciation over the next 12 months, we think that the investment in real estate is a really good investment. And this is just a quick example of, hey, if there was 4% appreciation, and on average over the last 30, 40 years, we've seen 5% or more appreciation. But you bought a $400,000 house, you put 10% down, it's a $40,000 investment, and you have 4% appreciation. That's a $16,000 profit. And on $40,000, that's a 40% return on your money. So we know that not only does real estate create equity and profits, we also know that it creates net worth. So the top 1% of the population has a $10.8 million net worth or more. The top 2% is $2.5 million. Top 5% is $1 million. Top 10% is $800,000, and top 50% is $500,000. But the biggest thing on here is that 2/3 of your net worth comes from home equity. And so it is a good investment over time. And so I know that you guys know this as real estate agents, but this is just continues to be and to show that this is where your net worth is going to land over time. Now, some of you have heard this already. I'm going to try and play this. Hopefully it comes out. But basically, this is Dave Ramsey. Dave Ramsey is a financial advisor. But he's probably one of the most known conservative financial advisors that I would say that there is. He basically says pay cash for everything except for your house, and when you buy your house, your goal is to pay it off. But basically, he is very, very conservative, and this is what he's been saying. Hopefully, I can get it there. Sorry. Let's see here. Nope, it's not going to work. I'm sorry. Basically, what he says is that now is the time to buy. The prices of homes are only going to go up over the next 5 years, and basically, this is the lowest price point that you're going to see over the next 5 years, and that you can always refinance. So even at today's interest rates, as high as they are, if you qualify and can make the payment, that you can refinance later on to lower your payment. And this is just more kind of proof that housing is very, very strong. So this is Dave Ramsey. You can Google this. You can go out there and listen to some of his podcasts, but basically this is out there on a lot of social media right now that is going around that he is promoting to buy now. So as the rates do improve, so we will have very, very strong fundamentals. There's low inventory, there's high demand, there's higher underwriting standards than what we had before. And the affordability, even though it's a little bit more difficult, I will show you in a couple of slides how it's still affordable for people to buy houses at these levels. So this is another graph, shows the recessions, and basically it shows you that with the exception of 2008, 9, 10, that housing stays strong through recessions. And the reason why I'm pointing this out to you is that it still is, again, creates wealth for you, but it is a good long-term investment. Back in 2008, 2009, when we had the housing crisis, we had very lax underwriting standards. We had crazy programs. We had builders that were out there building too many homes, and there was a glut of inventory. And so when you have all those things going on, that's when we had the foreclosure crisis, and we had a problem, and obviously the values came crashing down. But they've gone up since then because we have low rates and very good underwriting standards. And in addition to that, the number of households is getting higher and higher. So I'm gonna go back to 2006, and there was a huge drop in the formations of households. When there was that huge drop of formations, we hit the most completions of homes in the history. So basically the builders were building a ton of homes, and they kept on building them, even though the formations, the household formations kept on going down and down and down. And so the builders were actually losing money. And today they've learned a bit of a lesson. And that lesson is that basically they've stopped. So now in this market that we're in right now, they've slowed down the building of new homes. And actually the household creations or growth has gone up since 2000, the mid 2010, 11, 12, 13. It's continued to go up. And not only has it gone up, over the last 10 years, the builders, I'm sorry, not 10 years, but 5 years, the builders have not been able to keep up with the amount of houses for those households. And so we're short, and there's different numbers that are out there, but nationwide, we're short anywhere from 2 million to 3 million houses. And so because of that shortage, there's a huge demand for these houses, and this is going to keep prices high. So even though we may have had a little bit of a dip here just recently with these increased rates, we still think that the housing market is a very, very strong market. In addition to that, the millennials are coming into the market, or have been coming into the market. So in the mid 70s, we started to see the birth rates actually go down. And so they went down, and we're at some low levels. And I won't go into the details on why I think that, but basically they went down, and they stayed down for a few years. And now it started to go up. So in the mid 80s, you hit, or 90s, you hit the top with the millennials, and you stay up there with population growth or birth rates. And so these people, these millennials, are the ones that we've seen buying houses. It is going to be continually stronger over the next 10 years with the population growth that we've had. So the birth rates are showing, and these guys in the blue are going to be the post-millennials. Those are going to be the next wave of people that are coming in and buying houses, and the formations are going to go up as a result of that. I'm going to just quickly go through this and just kind of say to you, look, I know that it's kind of crazy right now. This graph is a little bit on the low, or kind of dated here, but it's a normal cycle. The inventory every single year, it goes up in the summer, down in the winter, up in the summer, down in the winter, up, down, and you just follow that cycle. But now you've seen that cycle actually go down from the past 6-7 years. And so the inventory is still tight, but not only is it tight, it's during the winter months as well. So be ready for the spring as it comes around, because I think the low rates are coming, and you're going to see more and more properties that are listed. But right now, and again, this one's a little bit dated, but this shows you the listings across the United States. And as of September of 2022, so a couple months ago, there was 732,000 listings, but 41% of those were under contract. So that leaves you with about 400,000 homes over the whole United States that were available to be purchased. The rest of them were under contract. So we still have, like I said, this huge inventory issue where that is going to keep the pricing up. You say as we go into this recession, the unemployment rate is going up. All of these things are kind of negative things. And the media is saying that the foreclosures are up by 150%. Don't believe the hype. Keep in mind that it is up 150%, but it's up 150% from September or from 2021, when there was a moratorium on foreclosures. We were not letting anybody go to foreclosure at all. And so, yes, they are up, but comparatively, if you look back to 2008, 9, 10, 11, when we had the issue, the housing issue, we had way more foreclosure activity. I mean, you're talking about 1% of these things. It is a huge number from 2008, 9, and 10 down to 164,000 currently in 2022. So it is a very low number of foreclosures. I do not see the foreclosures coming down. One, because of that issue. Two is because the average equity in homes is 58%. So we have a huge amount of equity in the houses, along with very low interest rates. So if you didn't miss the boat of refinancing and getting a 3% mortgage, you might be in trouble. But even at that point in time, if you have 50% equity in your house, then you're most likely going to sell it and not go into foreclosure. So I don't see foreclosures being a problem going forward. Affordability. The affordability is, again, is one of those things where, the prices have gone way up, and how are people going to be able to afford those houses with the high prices? Okay. And so I'm not going to spend a whole lot of time on this, but basically the first line is 2021. You could go get a loan for $400,000 at a 3.5% rate and have a principal and interest payment of, just under $1,800, and your income was $9,000. Well, in 2022, there was 15% appreciation. The housing prices go up to, or the loan amount goes up to $460,000. Your interest rate goes to 7%. Your payment goes up by $1,264 to $3,000. But you have to keep in mind, based on ADP's numbers, that if you stayed at your job, you had a 7.7% increase in your pay. Or if you switched companies, you might have had more like a 15%. So we took an average of 9% increase in your pay. So instead of being at $9,000 in 2021, you went up by $810 for a 9% increase, and you're at $9,810. So that makes up a lot of that difference from that $1,264 payment increase that went up from 2021 to 2022. And now you're probably saying, well, Mike, what about the gas, the food, all the inflation and all those things? Well, those went up as well. And so now you're at $1,500 increase from 2021 to 22 based on those increases. Well, if you go one more year and you do a 7% increase in your income is going to go up by another, to another $1,500, or a total of $1,565, which would complete that affordability for that particular house. Now, what I'm going to tell you going forward is that interest rates are going to go down. And so over the next 6 to 9 months, you're going to see lower interest rates, and you can do a refinance and lower your principal and interest payment as well. And so again, this is just my opinion of what's going on, but I do see all of this data that I'm giving you is basically showing you why I think that. And so we have the data to back it up here. So I think that it's a perfect time to buy a house, especially with the reduced interest rates of this last week. Now, I've been kind of talking about the 2-1 buy downs, and I'm not going to go into detail on this call, But basically, if you did get into a 2-1 buy down, you can have a, let's see, interest rates, let's say they're at 6.5% today. So you can go down to 4.5% on your interest rate for the first year, 5.5% for the second year, and 6.5% for the third through the 30th year. But keep in mind that if you refinance during that buy down periods, the unused portion of the buy down fund, and if you want more details on this, I can go over it with you in detail, so just email me or text me. But basically, the unused portion of that buy down fund goes towards a principal reduction. So if you owed $400,000 and you had $3,000 left in your buy down account and you went to refinance, you would only have to refinance for $397,000 versus the $4,000. Now, keep in mind that that $3,000 comes from the seller who you bought the house from. So that's not even really, it wasn't even your money. It was the seller giving it to you for the buy down fund. So if you want more information on that, just email me or text me and I can go through that. So incomes are going up, inventory is tight, rates are dropping, increased buyer activity pushes those prices higher. So what I'm trying to say there is basically the appreciation over the next year is going to be driven by the lower interest rates and people going in and buying houses and the lower inventory. So all of those things are going to push interest rates, are going to push prices a little bit higher, and you will have appreciation. So where do I think the 2023 rates are going to be, and when are we going to get to 5%? So this is the Mortgage Bankers Association, and I know this is kind of a little bit of a lot of information here, but this is one of their sheets. And 2023, this is the first, second, third, and fourth quarter. And down here is where they put the 30-year fixed interest rates. They think first quarter, they're going to be around 6.25%, second quarter, 5.75%, third quarter, 5.5%, and then the fourth quarter down to 5.4%. And in 2024, they think that it's going to go down into the 4% range over time. So that's a long ways away from now, but you can see that over a period of time that the rates are going to get better. One of the things that impacts the rates is servicing values. And I've talked about this with a few of you guys, but basically interest rates, the rates that we quote to a borrower, are made up of two things: the prices on the treasuries, on the US treasuries, mortgage-backed securities, and servicing values. So the servicers that we transfer these loans to, they buy the servicing rights from us. And so when we sell those loans to them, the servicers pay us, 1.25%, 1.5% for that particular loan. And so over time, you basically have that combination of the prices on the treasury bonds and the servicing values. You combine those, you get the rates. Well, right now, and this is another reason why we think that rates are going to come down. Right now, the servicers, based on the research that they have, are basically saying, I think that interest rates are going to go down, and the loans that we're doing today are only going to stay on our books for the next 12 months at a maximum, and they will be refinanced. So the servicers, when they pay us for these loans, they're expecting them to be on our books or on their books for a minimum of 5 years before they start making money. Once they've been serviced for 5 years, then that's when they start to make money. Well, today, if you're a servicer and you're going to buy a loan that is going to pay off within 6 to 9 months, you're not going to pay 1.25% to 1.5% for that loan. In fact, they're not paying really anything for those loans. And so right now, the spread is 300 basis points. So the yield on the 10-year treasury is was at 4%. So this slide is, again, it's a little dated. Right now, the treasury yield is a little bit lower than that, but interest rates were at 7%. So the difference, the spread there is 300 basis points. Normally, with all of these red arrows that are going back and forth, this is the spread between the 10-year treasury and the 30-year fixed mortgage rates. And it's normally, the spread is normally 1 3/4 to 200 basis points between the two. And so that's a normal spread. And so right now, with this yellow line over here, the current spread is 300 basis points. So as the yield starts to come down and prices start to come down on the treasuries, mortgage-backed securities, the servicers will start to pay more for those loans, and the spread will come down, and will come back down to the normal spread of 175 to 200 basis points. And so that's another reason. So as the yield comes down and the rates come down, the prices for the servicing values will go up, and we will see lower interest rates faster than what we think that we're going to see them. And so I think they're going to come down a little bit faster than what Fannie Mae and Freddie Mac are saying with their news. So I think the Fed, not only have they gone too far, but they're going to continue with rate hikes. They're going to go too hard, too fast, and you're not going to have a soft landing. It is going to be, you're going to go into a recession. And when you go into the recession, if we're not already in one, then you're going to see the rates start to come down. So going back to the beginning of the slide, when we talked about the recession and interest rates coming down, those show that every time we go into a recession that the interest rates come down. And so these things, the Fed is going to go, again, too hard and too high with their interest rate hikes, and they're going to have to. In fact, they're already talking about, the news is already talking about lowering the Fed funds rate at the end of 2023. So like this time next year, you're going to start to see the Fed lower the Fed funds rate. Just to solidify, I think that the inflation numbers are going to go down. The impact from the Fed increased rates are going to bring down the inflation. The supply chain issues are all getting resolved right now, and there's less stimulus and corporate growth that are going to drive the inflation higher. So instead, it's going to come back down, and we're going to replace all of these high numbers, not only with lower numbers, but with very probably it could be negative numbers of month-over-month inflation numbers. So when you start to get rid of each one of these over time, you're going to see the interest rates come down. So this is 11 months here. This is the 0.3% is the one we just added on. But all of these, you're going to start to see lower rates, lower inflation, lower CPI numbers, consumer price index. So you're going to see those numbers come down over the next 12 months. And as I said before, I think the shelter is going to come down as well. So even though there's not as much inventory for rentals, I think that you will start to see those come down as well. And once those start to come down, so too will the inflation numbers or the CPI. So I think second quarter of 2023 that we will see rates at 5% or lower. So I know a quarter is 3 months, and so that's a long period of time. But I do think that the inflation numbers will be very, very well resolved by that period of time, and we will start to see the rates come down. In fact, as the bond traders are basically, they're first in and first out. So we call that FIFO. And what I mean by that is when they start to see things that are negatively affecting, or inflation that are going to negatively affect the economy, they go first in, and basically the rates go up, and they start trading, and the rates will start to go up. But they also see it on the outside as well. So when they see things improving, when they see the numbers improving, then they are the first ones to basically show that the rates are going down, and they will continue to trade the rates down further and further. Whereas the Fed, they look at data from the past. they're not looking into the future, they're looking into the past, and they look too far into the past and basically make their decisions based on that information. So one more thing to back me up a little bit is there was an article, you can Google this and basically just say mortgage rates will fall to 4.5% in 2023. And you'll see an article from CNBC that we will be in the 4.5% range by the end of 2023. So now that I've said all that, I will go into a question and answer time for a little bit here. If you have any questions, you can unmute yourself and go ahead and ask a question. And we have about, maybe 5 to 10 minutes if you want to take that time. If not, that's all I have for today's presentation. So does anybody have any questions? Does anybody disagree with what I said? Is anybody there?
Hello.
I'm here.
All right. Any questions?
Mike, I have a question. This is Ellen Ben David.
Hi.
Hi. So is there, I don't know, I didn't see all the printout, but is there a way we can get like bullet points from that?
So this presentation will be on my YouTube channel probably by tomorrow morning. And so if you want to get this presentation, you can have this presentation. It'll just go to my YouTube channel. If you go to YouTube and search Mortgage Wise, it will be there.
Okay, thank you, Mike. Thank you so much for that.
Yep.
Mike, I have a question. How does the war in Europe affect what's taking place in the market?
Yeah, so that could be one factor where, you've heard some of these economists talk about sticky inflation and where it stays around a little bit longer than what we anticipate. So if the war continues over there and the United States continues to contribute funds towards that war, in fact, I think we gave more this week or last week, but basically if they contribute more and more funds to that, that may have the inflation stick around for a little bit longer and keep the interest rates a little bit higher for a period of time until that really, gets some type of resolution.
And if we get sucked into it.
Yeah, if we get sucked into it, that's right. Basically we are sucked into it. And in my opinion, at this point in time, we're just basically giving them money to, to basically fight this war. And if we have to, I know what I don't know if it was ever confirmed yesterday or not, but the missile that was dropped on Poland or not, I haven't confirmed that yet, but that's another kind of thing that is, an outlying factor that we don't know is going to happen in the future. So there's unknown circumstances that may affect what I'm talking about today, and that could be one of them. Anybody else? Let me just look real quick. No, it's all right. Well, that's all I have for today. I appreciate you guys joining the call. And as always, here's my information. If you want to reach me, my numbers are up there, emails, social media, etc. But thanks for being on the call, and we'll look forward to seeing you next time.
Thank you, Mike.
All right. Bye-bye.
Thanks so much.
Thanks, Mike.
Bye-bye.
Thank you. Bye.
No problem. Bye-bye.